Hello and welcome to BQ Prime. A very good morning to all the viewers. You're watching Stocks in Focus and I'm Hiral Datia. Two companies that we are looking at in today's session is one Cholamandalam Investment and Finance and two Thermax. Both the companies have reported numbers. Let's quickly first go across to Cholamandalam Investment. If you see from an earnings perspective, the AUM growth has been robust. There are minor challenges in the new business, but clearly the growth outlook stays absolutely strong. Let's actually welcome in our guest to discuss more. Joining us is Arul Selvan, President and CFO at Cholamandalam Investment and Finance. Arun, good morning and welcome to the show.
Morning. Yeah. Thank you.
Arun, my first question coming to you is clearly has the number met your internal expectations?
Yes, we have done good growth and profitability is as per our targets across all parameters, including stage three, which is the delinquency reporting. We have improved over Q1, and it is actually one of the best over the last few quarters. And we have also raised capital, though it came in the first week of October. So in all counters, we look really on a good solid footing.
Right. Clearly, the NI as well as the other income has been higher, on the back of which we've seen a profitability boost as well that has come in. If you talk about the net interest margins in the second quarter, that has improved. What's the trajectory looking like going forward? Are you expected to maintain similar levels, or are you expecting a further improvement to come in there?
It should improve a bit, though marginally. Primarily, it is dependent on two factors. One, the cost of funds staying where it is or improving marginally. The second is the vehicle finance book, which is a fixed rate book, which is where we could not, catch up on the NIM cost of fund increases and therefore the NIM levels earlier, is now changing profile as we keep on adding new portfolio with a higher yield levels. So vehicle finance book has started, improving yield, and that should also contribute to the NIM improvement. So we see NIM improving over the next 2 quarters. Yeah.
Okay. And how big a factor is the repricing of the fixed rate book, contributing to the expansion in terms of the net interest margins?
See, the vehicle finance book is around 60-61% today. So, but it will get repriced progressively because still a large part of the book is the COVID periods book, which has been when the rates were low. And so we had also passed on to the customers lower rates. So that book remains at those lower rates, while on the other side, the cost of funds has increased because most of the cost of funds are linked to either MCLR or repo or the T-bill. So we had to manage this increase. So this is a temporary phenomenon because the reductions were given by RBI as a relief towards COVID and thereby an expected increase in credit losses at that point in time. If you compare, we are almost at similar levels of pre-COVID on cost of funds. So we need to move back on the yields. And I think over the next 4 to 6 quarters, the yields of vehicle finance as an entire book will start changing color. And therefore, then you'll see some NIM improvements.
Okay. From an asset quality perspective, overall it has remained stable. However, with the expected increase in stage three of new products, how are you seeing that trajectory?
See, the new products, I think that yes, we are also cognizant that there has been some amount of concern raised. But frankly, the new product which has shown some amount of spike is one part of the unsecured business, which is like 1/4 of the overall unsecured business, which is let's say around 1.5% of the book today, around 2,000 crores. So that book has shown, and there we are covered by FLDG, and we have tried to explain this, but I think there is a little bit of an, communication gap or understanding issues, but we will allow things to present by themselves as we move into the next few quarters and show that it's not of a great concern. But that book, yes, it is a book which is unsecured and has a tendency to go to the levels where we are seeing them to be right now. So that is again within our expectations, and we see that it is not going to swing too badly. But I would leave that to the judgment of the investors and analysts. But let them come back and let them realize what we are saying is correct or wrong as we move into the next few quarters.
Right. And with regards to the fintech partnership portfolio within the new business, will you be maintaining similar growth levels, or do you think you will be slowing down in terms of the growth aspect of this segment, taking into consideration the stress that we are looking at?
See, all the new businesses, whether it is the unsecured part, which is again broken into two parts, which is the through the fintech and through our traditional route, as well as the SBPL, which is the small business personal loans and the SME loans. All these new businesses, when we started 18 months back, they were on a low base, so the growth percentages seem to be very high because the base is very small. But as we move forward, the growth percentages will change, but in value terms, they will be incrementally increasing. So I don't know how people would like to read it. If that growth percentages seem to have dropped, then it can be read as that we are slowing down. But if it is read as an absolute terms, we are increasing the disbursements as well as the asset levels, then we will be growing the book. And our intention is still to grow all these books.
Okay. So with the fundraise that we've seen, the recent one, will you still be able to maintain a ROA of over 20%?
Yes. No, ROA is not to 20%. ROE you are
ROA,
talking, I
yes.
think.
Sorry, I beg your pardon, ROA.
ROA,
Yeah.
uh, yeah. No, ROE, we are never committing 20%, though we may be delivering in the 19% range. I think we should be comfortably above the 17 of 18%, and we will not let that drop. So there will be some bit. That's where we took the fundraise also into two parts: one as equity and one as convertible debentures. So the conversion happens as and when we need it over the next 2 years. So this will help to sort of manage the ROEs, which will be in the 17 of to 18 of percent.
Right. And my last question coming to you is across segments that you are operating, where are you seeing the growth to come in from, and where do you think there could be some bit of stress that needs to be monitored?
See, the last quarter had been a good quarter across all business segments. Vehicle finance grew, LAP grew, HL grew, and the new businesses also grew well. And we see that sort of repeating as we go into the next two quarters, because the festival season seems to show a good growth in the auto, especially in the passenger vehicle, and we also see a good traction in the used vehicles. But auto is a little bit cyclical, so you may have to see some reductions over maybe next few quarters, not the next few quarters, but after that it will go through some cycle. So that is the whole point of we diversifying into multiple product lines, which could help us ride different cycles of different products.
Right. So I think lots to watch out for from here on. Thank you, Arun, so much for joining us on the show and sharing your views as well. Clearly,
Thank
if you see
you.
from a stock price performance as well, over 50% is the kind of gains that we've seen with regards to where Cholamandalam investment and finance are concerned. And this is over the last 6 months. So interesting moves coming in there. If you talk from a brokerage perspective as well, majority of the brokerages have a buy rating on the counter. You have a Jefferies, which has clearly said that the growth outlook stays strong and they stay positive. They have a buy rating and a target price of a price target which is almost 1350 on the counter. So that's with regards to where Cholamandalam is concerned from a Jefferies perspective. If you talk about Nirmal Bang institutional equities as well, they also have a target price of 1350, which is an upside of almost 19% from the current market price. And overall, if you go to see, they have changed their estimates, target price, and the rating on an upward move. So a buy rating coming in by Nirmal Bang Institutional Equities as well with regards to where is concerned. Clearly, the key focus for them now is going to be in terms of the net interest margins trajectory, which is expected to see some good growth. They are cognizant of the stress that is coming in terms of where the new businesses go. However, they are trying to see what can be done on that front. ROE, in terms of that, around upwards of 17%, but below 20% is what they will try to maintain. So 17 to 19% is the trajectory that we're looking at with regards to where the ROE is concerned, with regards to where Chola goes. And very lastly, in terms of the asset quality as well, in the fintech originated unsecured loans, that has increased, but this is only around 1.5% of the total AUM, and they should be delivering almost a 29% EPS CAGR with regards to FY23 to 26 is a lot of the brokerages which are indicating. So that's with regards to where Cholamandalam investment finance goes. But let's quickly shift focus to a Thermax. Now, Thermax, if you see, the revenues are absolutely in line. Margins and profits have beat street estimates. Let's welcome in Ashish Bhandari, MD and CEO at Thermax, to understand more. Ashish, good morning and welcome to the show, and a pleasure to speak to you as always.
Good morning, and it's my pleasure to be here.
Thanks. Ashish, my first question coming to you is, clearly, we've improved on the margin front. Profits are up 45%. Have the numbers met our internal expectations?
Yes, actually, in some cases, even exceeded our internal expectations on the profitability side. There was one particular project, roughly about 25 crores of profitability. This was an international order that got completed this last quarter, and we did a particularly good job on execution on that project. So it has given us a slightly additional bump. But in general, the environment is stable. We have said that for some time that last year, with all the commodity price moves, it was very difficult to pinpoint prices. And currently, with a stable environment, we are doing a better job, which is reflecting in our bottom line as well.
Right. So clearly, if I'm seeing the first half FY24 performance as well, industrial products, green solutions, absolutely strong revenue growth is what we've seen. Industrial infra has grown at low double digits, while the chemical segment has been the weakest with a 2% year-on-year growth for the first half of FY24. Going ahead, which are the segments that are expected to be the growth drivers for the business, and where are you expected to see weakness?
Look, all four overall are, I expect them to grow. Yeah, all four. If I say relative positioning, overall, I'll take them all one by one. Yeah, chemicals would like to see more growth, happy with the profitability, but this has to become a much bigger part of Thermax. And for that to happen, we need to grow the business a lot faster. And here we have had, with all the, especially, most of our business out here is exports. There's been some weakness which has affected us on our top line number. But my expectation is that the business continues to grow. Green utilities and green solutions, we are putting in a lot of money, and you can see a lot of our capex is going out there because these are all build own operate businesses. And here there's a lot more surety that the business will go because the orders are coming in, and each contract on is either 10 years or 25 years. So these are long-term contracts with customers. I expect that this business in 3 years would be somewhere between 10 to 15% of Thermax. Industrial products, particularly happy with how this business is working. Growing double digits, growing profitably, and in some senses, continuing to show the general multi-industry strength of India right now. Industrial infra, large projects have been few, especially in the first half. We haven't done a good job of winning large projects. I do expect that the second half would be better. and an expectation that the profitability in this business also continues to improve. So overall, I do expect a better performance in the second half on orders. The strength overall in our baseline and profitability, I think maybe Q2 was a bit of a high, but in general, the improvement from last year, I completely expect to see and deliver.
Right. So overall, what's the order book looking like, and what's the executionable pipeline so far from the existing order book in the current financial year?
Backlog of 10,200 odd crores is quite stable and has been there for some time, which means executing about 2,500 crores, something in this nature, should be doable. Yeah, what I would like to see now is starting to get back on that orders growth. For 4 quarters in between, we were doing that. This last quarter was a bit of a step back, and would like to see better orders growth in the second half.
Okay, and what's the target looking like? Any number that you can share with us?
See, with large projects, very difficult to determine. What gives me confidence is that the pipeline of overall projects we are bidding on is decent. So we know there are a few things in play, but the sectors that are in play right now, steel, cement, biofuels, some international projects, they are tough to pin down from a timing perspective. I've said that previously as well. Refinery and petrochemical, especially government-driven projects, there's slightly more certainty that if you bid it in a particular month, the bids will open in a particular period and know if you won them when you will get awarded. Right now, the clarity is a little less. That said, as I said, the overall set of projects we are bidding on still give me confidence.
Okay. And with regards to new order inflows, will the concentration be with regards to industrial infra? Because that has been a segment where the order balance is slightly decreased on the back of project executions. Plus, as you mentioned as well, you are looking out for bigger orders, which were there in the previous year. So is this segment going to be a focus area?
Yes, it would be. I think because this is the sector from where some of our bigger orders come. The caveat that I would put is that my expectation is that we get good orders and orders that we can execute profitably. There has been a tendency in the past that some of our larger projects have also been some of our less profitable orders. So I think we would like to break that trend. And while industrial infra will be dilutive overall, from a working capital perspective, we do a great job. These are all typically negative working capital projects. And while margins are relatively lower, I do expect margins out here also to be better than what we have done in the past.
Right.
And even that goes for the new orders as well.
Right. And with regards to the litigation pertaining to the customer equipment breakdown, where does it stand currently? And, what's the provisioning done so far, and how much more is expected?
See, we have taken a reasonable provision last quarter of 50 odd crores. The overall exposure is slightly more than 200 crores. We have our case now will get heard in the higher courts, and that process has started now. We have stated whatever we can publicly in our previous press release. There's nothing more to add. You will see that in this particular quarter, we will also make a cash deposit to the effect with the courts to put our stake. But overall, whatever we have stated in our previous press release, we stand by that even now.
Right. And Ashish, my last question coming to you is, in terms of FY24 as a year, what's the kind of CAGR growth that you're looking at? Will it be maintained at current levels, or is it going to be better than what you've done so far in the last 3 to 5 years?
Look, we'll all have to wait for the second half to see how it unfolds. And for larger projects in particular, tough to determine. Yeah, when we started this year, my expectation was that we would be able to do a double-digit growth this year. And we have clearly not done that in the first half on orders, but I do hope that the second half would be better. Yeah, and as I said, there's a reasonable pipeline.
Right. All right. Thank you, Ashish, so much for joining us on the show and sharing the views. So clearly, the second half is something that we should be watching out for. So that's with regards to where Thermax goes. Yes, there has been some bit of a weakness that we've seen with regards to the second quarter in few of the segments. Now, whether the large orders will come through in the second half where the company is looking at is what we need to wait and watch. YTD almost 50% is the kind of up move that we've seen on the counter. That's all that we have in this session. Thanks for watching, and lots more lined up on the other side. Please stay tuned to BK Prime.